Imagine losing 20% of your money overnight. How would you react? Panic and sell everything? Or stay calm and stick to your plan? Here's the shocking truth. Your answer to this question matters more than picking the perfect stock, and most investors get it completely wrong. Today, I'm revealing the exact formulas that determine whether you'll reach your financial goals or fall short by decades. Most people think investing is about finding the next big winner. They spend hours researching stocks, watching market news, obsessing over which company will explode next. But here's what the experts won't tell you up front. Where you put your money matters way more than what you pick. This is called asset allocation, and studies show it's responsible for over 90% of your portfolio's performance. Yet, almost nobody talks about the actual rules you should follow. The rules that tell you exactly how much to put in stocks versus bonds versus cash. The rules that adapt as you age. The rules that keep you from making catastrophic mistakes when markets crash. Until now, asset allocation is like packing a suitcase for an unpredictable trip. You don't pack only t-shirts or only jackets. You pack a mix because you don't know what weather you'll face. Your investment portfolio works exactly the same way. Stocks give you growth but swing wildly. Bonds provide stability but lower returns. Cash keeps you liquid but loses to inflation. The magic is in the mix, and there are proven formulas that tell you exactly what that mix should be based on who you are and where you're going. But before I reveal those formulas, you need to understand 3 critical factors about yourself. Miss any one of these, and even the best allocation won't save you. First factor, risk tolerance. This isn't some theoretical concept. It's how you actually behave when your portfolio drops 20, 30, even 40%, and it will drop. That's not pessimism, that's history. Here's the brutal reality. If you can't stomach watching your account lose thousands without panic selling, then loading up on stocks will destroy you. You'll sell at the bottom, lock in losses, and sabotage your future. This is called loss aversion, and it's one of the biggest killers of investment returns. The pain of losing $100 feels twice as strong as the joy of gaining $100. So ask yourself honestly, if your $10,000 portfolio became $8,000 tomorrow, would you lose sleep? Would you sell? If yes, you need a more conservative mix no matter what anyone tells you about long-term returns. On the flip side, overconfidence is just as dangerous. Thinking you're immune to risk, that you can time the market, that rules don't apply to you. That's how people blow up their accounts. Know yourself. Be ruthlessly honest. Your allocation must match your actual temperament, not the investor you wish you were. Second factor, time horizon. This is your secret weapon, and most people waste it. Time horizon means how long until you need this money. Retiring in 35 years? You can afford to ride out crashes because you have decades to recover. Buying a house in 2 years? You can't risk your down payment on stocks that might tank right when you need the cash. Here's the key insight. The longer your timeline, the more volatility you can handle. A market crash that lasts 3 years is terrifying if you need the money tomorrow. It's a buying opportunity if you don't need it for 20 years. Young investors have the single biggest advantage in investing: time. You can weather every storm, benefit from every recovery, and let compound interest work its magic, but only if you match your investments to your timeline. Short-term goals get safe assets, long-term goals get growth assets. Mix them up and you're gambling with your future. Third factor, liquidity. Can you access your money quickly without losing value? Life throws curveballs. Car breaks down, medical emergency, job loss. If all your money is locked in liquid investments, you'll be forced to sell at the worst time. Always keep some easily accessible cash. Now, here's what you came for. The actual formulas. First is the classic 60-40 split, 60% stocks, 40% bonds. This has been the go-to moderate allocation for decades. It gives you growth from stocks and stability from bonds. But is it right for you? That depends on your age. Which brings us to the age-based rule. Take 100 and subtract your age. That's your stock percentage. You're 30? 70% stocks, 30% bonds. You're 50-50 split. The logic is simple. Younger means more time to recover from crashes, so more stocks. Older means less time, so more bonds for protection. Some experts now say use 110 or even 120 minus your age because people live longer and returns are lower. So that same 30-year-old might do 80 or even 90% stocks. But here's the catch nobody mentions. These are starting points, not commandments. If you're 30 but you panic at every market dip, 60-40 might be better for you than 80-20. The formula gives you a baseline. Your temperament adjusts it. Want to get even more sophisticated? Use the bucket strategy. Divide your money into 3 buckets by timeline. Bucket 1, money you need in 0 to 2 years. This is pure safety. Cash, savings accounts, maybe very short-term bonds. No risk. You need this money soon. Bucket 2, 3 to 10 years out. Moderate mix. Some bonds, some stocks, maybe balanced funds. You have time, but not decades. Bucket 3, 10 plus years. This is your growth engine. Heavy stocks, index funds, real estate, anything that compounds over time. The beauty of buckets is psychological. When markets crash, your short-term bucket is safe. You're not forced to sell long-term holdings at a loss. You can ride out the storm because your near-term needs are covered. This strategy removes the panic that destroys portfolios. You're matching each dollar to when you need it. Now, here's the secret that separates winners from everyone else: rebalancing. Your allocation will drift over time. Stocks boom, and suddenly your 60-40 became 70-30. You're taking more risk than you planned. Or stocks crash, and now you're 50-50 when you should be 60-40. Rebalancing means restoring your target mix. Sell some of what went up, buy what's down. This forces you to buy low and sell high, the exact opposite of what emotions tell you to do. How often? Most experts say once or twice a year is plenty. Some say only when you drift 5 or 10% off target. Either works. The key is discipline. Rebalancing feels wrong because you're selling winners and buying losers, but it controls your risk and locks in gains. Without it, your carefully planned allocation becomes meaningless. Let me rapid fire the mistakes that will wreck your allocation. Not diversifying. Putting too much in one stock or sector. If it fails, you fail. Diversify ruthlessly. Chasing performance. Loading up on whatever was hot last year. That's buying high, the opposite of what works. Ignoring your actual risk tolerance. Going full stocks because some guru said to, then panic selling in a crash. Never rebalancing. Letting your portfolio drift into dangerous territory without correction. And the biggest one? Letting emotions drive decisions. Panic in crashes. Greed in bubbles. Fear of missing out. These feelings will sabotage you faster than any bad stock pick. The solution? Make your plan when you're calm. Write down your allocation, your rules for rebalancing, your commitment to not panic selling, then stick to it, especially when it's hardest. That's how you win. Asset allocation isn't sexy. Nobody brags about their 60-40 portfolio at parties, but it's the foundation that determines whether you retire comfortably or work forever. The formulas I gave you today are your starting point. 100 minus age, 60-40, 3 buckets. Pick one, adjust for your situation, and commit. Then rebalance yearly and ignore the noise. Do this and you'll outperform 90% of investors who are still chasing the next hot stock. If this changed how you think about investing, hit that subscribe button. Drop a comment telling me your allocation strategy. And remember, you can't control the market, but you can control how you prepare for it. Thanks for watching.